We've got Chang, Neil Bawa, Bob Fraser, Greg Katz, some of the smartest minds in commercial real estate getting up here. They have a challenging investment thesis. They're going to figure out exactly, arguing two sides of the coin, whether they maybe agree with that or not. And gentlemen, feel free to come on out. Ben, let's make it happen.
All right. Thanks for running that game show, Mr. Bob Barker. Whoa. Oh, guys, somebody open those doors for me. Can I get a? Oh, we got signs up. I guess we can't do that. All right, listen. This is a big deal. These guys bicker all year long on LinkedIn. Who is more capable at evaluating the economic market? Chang, our lead for the against team. Neil Bawa, our lead for the for team. These guys bicker all year long. It's like my favorite little real estate drama, and the drama continues today. You are here at the best ever debate where we are going to be debating the motion. The Fed achieved a soft landing, and a new real estate cycle has begun. Hopefully, we're going to have this room fill up a little bit, but we're going to go ahead and get started. So, these are the rules of the debate. This is how we're going to run this thing. It's going to run in 3 phases. Phase 1, 2 minutes of opening arguments per person, followed by a back and forth dialogue where we debate the merits of those opening arguments. The merits, Neil. Followed by 2 minutes of closing arguments. And you, the audience, will decide who is the winner of this debate. How are we going to decide it? Not by voting at the end, but by voting twice. Once in the beginning, once at the end. We're going to vote for the motion. The team from Neil and Bob. The Fed achieved a soft landing and a new real estate cycle has begun. If you believe that at this moment in time, you will vote for the motion. If you believe that that is not true, if you are against the motion, the Fed achieved a soft landing and a new real estate cycle has begun, then you will vote against it. And if you are uncertain, you will vote uncertain. We'll do this a second time on the back half of this. And if you're ready to get going, you can go ahead and vote. We're going to do this a second time. Whoever has achieved the highest delta in points, in percentage points, whoever has influenced the most minds of the best ever conference will be crowned the winner for another year of the best ever intellectual debate. Are we ready, gentlemen?
Absolutely. Ready.
We're ready. All right. Well, before we get started, we are going to let 20 more seconds for those to filter in and check out the QR code on the screen. You, the audience, are going to vote and determine who has bragging rights to belittle the other for the next 12 months. Neil and Bob, John and Greg. Look at that face. Look at that face. He's got that presidential debate face on. He's like, I'm on MSNBC right now. I will not be by these other gentlemen. All right. So once again, if you believe that the Fed achieved a soft landing and a new real estate cycle has begun, you will vote for the motion. If the Fed achieved a soft landing and a new real estate cycle has not begun, then you will vote against the motion. And if you are unsure, then you vote uncertain. Anybody need more time? All right, then let's get going. Before we get started, now that we've had this open, and while we are tabulating the results, we can go ahead and close the poll. Oh, look at that. 50%, 51% for, 52% for. Oh, it's still going. It's still going. Have we closed the polls? Oh, we're just processing here. All right, so 55% believe the Fed has achieved a soft landing and a new real estate cycle has begun. That's very
interesting. It's going to be 100% in 30 minutes.
Well, that's right. That's going to be 100% in 30 minutes. Well, these gentlemen have a harder task. They've only got 45 percentage points that they can make up. Meanwhile, only 16% believe the Fed did not achieve a soft landing and a new real estate cycle has not begun. So you guys have 84% out there that you can influence the minds of. And look at these independent voters, these 28% swinging the election. That's who you're after, isn't it? That's who we're after.
I'm going to take Neil's. I want his stuff.
Oh,
man.
You don't care about the undecided. You're going to convince the other side. All right, so let's introduce to you our debaters. We have Neil Bawa, CEO of GR Capitus. If you don't know him, you are, to put it kindly, living under a rock. He is the mad scientist of real estate data. He has been doing this for, can I age you? Decades?
Yeah. Second decade, yes.
Second decade, all right. And we've got his co-team member here, Bob Fraser, CEO, co-founder of Aspen Funds, who is not your first time on the debate stage. Is that right?
Correct.
When was the last time you were here, Bob?
Maybe 3 years ago?
3 years ago. And remind me, was that a win or an L, that go around? Was that a W?
I can't remember.
Can't remember. Oh, it's more important to you than that. Don't play with me. All right, and on the right-hand side here, so these are the syndication team, if you will. On the right-hand side here, by stage right, if you will, we've got John Chang, Senior Vice President of Research and Insights at Marcus Millichap. And we've got Greg, I'm sorry, remind me the last name. Is it Katz?
Yes.
Greg Katz, yeah, thank you. Greg Katz, subject matter expert, Director of Insights for the real estate sector at Esri, which I'm a client of. And Esri has more data, I think, than any other partner I've ever worked with as a data guy myself.
I would agree.
Yeah, anybody here use Esri for their market research? You use Esri? Of course, Neil uses Esri. Of course, Neil uses it. All right. So now that we've gotten to know each other a little bit, we're going to go ahead and get started. 2 minutes on the clock. And gentlemen, remind me, who gets to go first? I know we decided this in advance. Did we not? You guys get to go first? All right, Bob, you ready? Or
Yes.
I'm going to go first.
You're going to go first. All right. So we're going to do 2 minutes on the clock. I am going to cut you off. So we're going to do exactly 2 minutes. We've got the time right in front of us here. We're going to go from the outside in. Neil, John, Bob, Greg, you're going to close this out. And on closing arguments, we're going to go in reverse order. Sound good?
Yep.
All right. With that, let's go. Neil, you're up first.
Good afternoon, everyone. We are here for a debate that, quite frankly, should have ended a year ago. But thanks to our friends over there in the doom and gloom squad, otherwise known as the sky is falling society, we are once again forced to answer the same tired question: did the Fed succeed with a soft landing? The answer is obvious. Look at the numbers. It did. And I get this. It's easier to constantly predict a real estate recession. My friends over there have forecasted 9 out of the last 2 recessions. 9 out of the last 2, right? Every time the economy stumbles for 1 month, they start screaming, "This is it. The end is near. Are we there yet, mommy? Are we there yet?" Let's talk about what's actually happened. The Fed raised rates a gazillion times, and yet here we are today, standing in an economy that has refused to break. Where is the surge in unemployment? I ask you. Where is the corporate earnings collapse? Where is the mass panic? Spoiler alert, it never showed up. The economy proved these perma-bears wrong. Oh, and my favorite part, these guys, they're constantly moving the goalpost every single month. Last year in April, they were freaking out about job growth slowdown. Nothing happened. In January 2024, they're hyperventilating over a tiny CPI increase, but by Feb, inflation settles down. This is what they do. It's like that broken old Garmin GPS that keeps saying, recalculating, recalculating. And meanwhile, the real story is unfolding in front of us. AI is here. This is not just another hot trend. It's the biggest economic accelerator that we've seen since the internet. Since ChatGPT came out, we've seen an explosion in AI investment, in corporate productivity, in tech hiring. And if you don't believe that AI is boosting this economy, you need to take a look at the stock market. AI didn't just survive the Fed's rate hike, it thrived. So here's the truth. The recessionistas were wrong in 2022, wrong in 2023, still wrong in 2025. The economy isn't going into a recession, it's transitioning, and the Fed didn't drive the economy off a cliff. They landed the plane so smoothly that the perma-bears are still looking for the wreckage. Thank you.
Neil, I think. Was I supposed to take notes? I'm not sure. All right, John, you are up next.
Neil, did you read that? Are you using a teleprompter over there? Have you hit that point? Are you there?
I've got other stuff in here. Watch what happens.
I can only imagine what you have stashed away. All
All
right.
right, let's start the clock over. 2 minutes on the clock. Thank you.
Okay, so soft landing. The Fed achieved a soft landing. That's the premise, right? So what can we have? We can have a soft landing. We could have a hard landing, which is a recession within 2 years of the rate reductions, or we can have no landing. In other words, the inflation rate never came down. Now, Neil is talking about all sorts of different things, and he's throwing in all sorts of arguments to hide the actual conversation. He is trying to distract you from one thing. Did we get a soft landing? Did inflation hit the Fed's target? Did they reduce rates? And did the unemployment rate stay low? So we haven't had a hard landing, not yet, although we look like we may have negative GDP in the first quarter. We have reduced inflation considerably, but it is not at the Fed's target. The Fed's target is 2%. Right now, CPI is at 3, core CPI is at 3.3%, and core PCE is at 2.8%, and they are trending up. So we have not achieved a true soft landing because we have not gotten the inflation rate down to the goal. It is as simple as that. It is black and white. Has the inflation rate reached the target? No. Has the Fed reduced rates substantially? They started to. They thought they were going to have a soft landing. Things were going the right direction, and then they hit some turbulence. They're bouncing off the runway and going up around again. So I don't think that we're there. We got close. But we did not have a soft landing. And I don't think that the Fed plans on reducing rates anymore because they're afraid of what's coming around the next corner.
Thank you, John. All right, Mr. Bob Fraser, 2 minutes on the clock.
All right, good afternoon. Let me start by saying how sorry I feel for our friends, the collapse enthusiasts. They've been desperately hoping for economic catastrophe since the Fed started raising rates, and they're disappointed every time the economy refuses to die. But let me break it to you guys, you've lost this round. I hate to say it, but the panic patrol, they've been screaming, it's coming, the crash is coming, and every time they're proven wrong, they just move the recession to the next quarter, like a doomsday cult, rescheduling the apocalypse one more time. Instead, here's what we've seen. Consumer spending is up 40% since the end of COVID. Individuals are sitting on $4.5 trillion in cash, 4.5 times more than before COVID. Household debt service is at a record low since 2000. The wealth effect, real household net worth, is up 30% since COVID. Real median income is up 23% since 2012. And the GDP growth is between 2.5% and 4%, in spite of the Fed raising rates 11 times at the fastest rate ever in history. It all speaks of economic power and resilience. Here's what's actually happening. The Fed didn't break the economy, they reset it. And real estate is not doomed, it's pivoting to the next cycle. The only thing that's really collapsing is the credibility of the people who keep getting this wrong, not to name names. So stop waiting for an apocalypse that isn't coming. If you do, you'll spend the next 5 years listening to the clickbait Cassandras, and you'll wake up in 2030 wondering why you missed the biggest investment cycle of the decade. Thank you.
All right. I love the fiery attention that we're getting here, folks. This is heating up. We're having some fun. All right, we're going to go 2 minutes on the clock. Mr. Greg Katz, close us out for opening arguments.
You know, I'm the rookie here in the debate world, and God, I wish you guys would actually have some facts that matter.
Woo!
Okay, so look, there has documented, there's only been five soft-ish landings since 1965. 5, with the last one being soft-ish in 1995. Okay, soft-ish. And that was a different economy altogether. Everything that these guys keep talking about is since COVID. What the hell isn't up since COVID? Everything's gone kind of back to some normalcy, and everything had the climb down, now it's had the climb up. But you know what else has happened since COVID? Prices have gone up. Inflation, big time. Anybody know about the price of eggs? Let's talk about the price of ground beef. Used to be $3.80 before COVID. It's now $5.55. Let's talk about bread. $1.94 a loaf is now $2.76. Your utility gas was $1. It's now $1.55. And I could go on and on and on, including transportation, which over 5 years is up 27%. Never mind housing costs. I mean, my kid can't even buy a house that he saved tons and tons of money for because he's been priced out. Everything is sky high. Inflation hasn't been tackled.
All right. Round of applause for these 4 gentlemen. What a fun way to get this debate started. Thank you very much. All right, I want to kind of nip this in the bud because we get into a semantic argument every year. So I want to go ahead and clarify. John and Greg, is the argument that the Fed has not achieved a soft landing because the landing was hard, or because the landing has yet to occur? Let's just get this out of the way.
We have not had a landing yet.
We have not had a landing yet. Okay, so then let me turn back this way and ask you folks. Draw the line in the sand. If the landing has occurred, when and what defines it?
The Fed dropped rates.
The Fed
Give me a
dropped
break.
rates.
They called it. They called
he
it. They
said,
reversed.
he said, 5 times softish. In every one of those cases, it's the Fed dropping rates that signifies a new cycle. The moment the Fed dropped rates and felt confident enough, you lost your argument. Because that's when a soft landing occurs. The Fed is in no hurry. They have no reason to drop rates at any point of time unless they feel confident. And they didn't drop rates once or twice. They dropped rates 4 times and have given forward-looking indication on the dot plot. 4 times, 100 basis points. 3 times 100 basis points, thank you. And they've given forward-looking indication in the dot plot of drops this year and also drops next year. So to say, if they're saying that we haven't achieved a soft landing, could you please go back and tell me since World War II, how many times did the Fed achieve a soft landing that matches your description?
So, how much did rates go up? How much did they raise rates during the rate hike cycle?
Anybody know in the audience?
525.
525.
So they raised it 525 basis points. Yes, they felt good about where we were last September. They were like, okay, things look like they're going the right direction. The plane's coming down, everything's looking good. Let's cut rates. Cut at 50, did another 25, another 25. Of course, Chairman Powell had his job threatened a few times in that process, but he's on board. Now, 100 is not 525, right? They have a long ways to go. The Fed funds rate is currently 4.25%. That's much higher than we've seen in the last 20 years. So if you think about it, the Fed, I didn't see Chairman Powell say, yep, mission accomplished, everyone. We've had a soft landing. No, he said, well, actually, I think we need to hold still for a while because we don't know what's around the next corner. We just had an election. We want to make sure that things are going to continue to run smoothly. And have they? Well, let's see here. We're talking about 25% tariffs on Canada, Mexico, 20% tariffs on China, effective tomorrow, no less. We're looking at shrinking our employment base through deportations. These are all things that cause inflation and are potentially flirting with a recession. So the thing is we've gotten some good momentum, but they called it off. They waved off the landing and said, whoa, we're not there yet. Go around, let's see what happens. So we didn't get to the landing part. We got close, but we're not there.
We got close enough that he reversed course, 2.8% PCE versus 2. He thought it was good enough.
And they started. If you look at the trailing 3-month average, it's going back up.
So again, team, does the number matter or does the directional speed matter? What's the argument there? Is it hey, 2.8 isn't enough, it should be 2 or 2.5, or is it, hey, we went down, but we reversed course so quickly? Which argument, or is it both?
Well, I think you got to get to your definition. You guys need to define what a soft landing is, okay? Yeah. Because again, you still haven't addressed the fact that soft landing means inflation. According to Powell, inflation gets to a 2% level. Hasn't done that the entire time. So by definition...
Hasn't done that in past soft landings either.
No, soft-ish. Okay, we can debate the terminology, but soft-ish and soft are very different, okay? That one means, to John's point, I kind of got there. You kind of maybe, but you didn't.
Because
there was
the
a wait-and-see
economy was
problem.
too strong for the Fed to keep going. It was far too
Exactly.
strong.
But the Fed reversed course, and the Fed reversed course because they're scared of what they're seeing. There never was a soft landing. There was close maybe, but it never resided. I didn't get in my bed and lay down fully. I sat on my bed, but then I got back up.
Let me hit the historical argument here. They said, it's never happened before. But we've never seen the yield curve lie like it did for 18 freaking months, have an inverted yield curve every
Explain
single
that for
time.
the audience, please, Bob.
So a yield
Give us a
curve,
lesson.
you expect long interest rates to be higher than short interest rates. You get a premium for investing longer. It has been inverted.
Why? Why do you expect that? Sorry, I just want to make sure we're all following.
That's everyone. In fact, historically, the definition of it's called like something like, I don't know, 20 of the last 20 recessions having an inverted yield curve, meaning when investors choose to invest so much in the short-term bonds, the rates are higher. Anyhow, it hasn't happened. It's been lying. And we have never seen an economy when they've raised rates this rapidly, yet you see consumer spending, which is 70% of the U.S. economy, continue to go on a rip. And so what's happened, the strength of the economy has blown by all the Fed's expectations. And the yield curve is finally normalizing right now, where you see long interest rates are higher than short rates.
Wages are going up. He's talking about the price of eggs and the price of beef. Why isn't he talking about the fact that wages are up 40%? Why isn't he talking about the fact that currently wage growth in the United States is far faster than the inflation level? So if inflation is
consumer debt.
wages
So is
are
consumer
up
debt.
So I want to frame this part of the conversation, because what we're talking about now is an affordability ceiling and how it feels to the actual consumer, to the households, right? And so I just want to repeat some of the stats from the opening arguments. Bob said that household debt service is at an all-time low. Household net worth is at a high. Household median income is up 12%. GDP is on track for 2.5% to 4%. Yet, Greg, you made the claim that eggs are up, housing is unaffordable. The true inflation feel is not there. So I'm gonna ask you to respond first, and if you guys could counter, that'd be great. Can you frame this affordability ceiling for us, for the consumer, in terms of how it's going to affect immediate inflation and what that might mean for interest rates and an economic downturn?
You want Greg?
I mean, I'll leave it between the two of you guys, but yeah, your team can go first.
You start.
Wait, what was the question? Look, inflation is still going up, right? I don't know if I'm answering the question, so you asked Greg, but the thing is, inflation is still going up. I mean, Neil just said, hey, look, wages are up 4.1%. That's great, except it's inflationary. Normally, wage growth is supposed to be about 2.6%. He keeps talking about economic growth. He keeps saying, hey, the economy's doing great. People are making lots of money. Things are going up. Prices are going up. Values are going up. That's called inflation. And if inflation is over 2%, we did not hit a soft landing.
Okay, I'll take it. You guys want to respond?
Yeah, let's talk not about where inflation has been, but where it's going.
Okay, and I want to do one here, then I want to move on to another topic. So yeah, make the case here.
Okay, so we just saw OPEC come in and boost oil rates because oil production because of Trump's behest, and you're seeing oil prices now crashing down to $70. He's opening up, reducing the price of lumber by opening up logging. In order to reduce pricing. We're seeing the federal, kind of the layoffs and all the stuff it's all these things are disinflationary. All these things that he's doing are disinflationary. So, will we continue to see inflation going up at the rate it has been? I don't think so.
Absolutely not. I'd like to add one more thing. Elon and Trump are trying to get rid of 10% of the federal workforce. 3.3 million people work for the federal workforce. The average salary is over $100,000. If they cut the workforce by 300,000 people, multiply 100 grand with 300,000 people, those people are not going to be buying cars or buying homes. That is inherently deflationary for the economy. That is actually much more deflationary than these other inflationary things that they're talking about. And those are people who just started getting laid off now. Also, in addition to that, Trump wants to get rid of 1 million immigrants. Immigrants pretty much spend every last dollar that they have. Now you'll have 1 million people missing from the economy that are not spending any money. Yes, those million jobs have to go to somebody else, and that's going to cause a little bit of inflation, but we have 164 million jobs in America. 1 million of those will have slightly high inflation, but 1 million people will be missing from America and won't be spending money. To think that what Trump is doing is only inflationary is nonsense. He's doing some inflationary things, and he's actually doing much bigger deflationary things. And we haven't even talked as much about the oil piece, the lumber piece. Those are huge. They're actually doing more deflationary things than inflationary things.
Okay, so you actually transitioned to my next topic, so thank you, Neil. A response. The Trump administration, how does that impact the argument for the against team?
Think about this for a minute. 25% tariffs. 25% increase in the cost of goods. Tomorrow, 25%. That is 45% of consumer goods are imported from Canada, Mexico, or China. 45% of the food that we all eat is imported from Canada, Mexico, or China. And 45% of the building materials every developer uses are coming from Canada, Mexico, or China. And they're all going up by 20 to 25%. Does that sound like prices are going to go up or down? When you look at construction, the labor pool, 35% of the official labor pool, building houses, building apartments, building commercial real estate properties, are non-foreign born. The real numbers are probably higher than that, and if we deport and move a lot of these people out, we're going to reduce the labor force that is building all of those buildings. And when you shrink the labor force, you have a labor shortage. A labor shortage means you're going to have to pay people more to do the same work because you don't have as many people to choose from. That is inflationary. We went through that in 2022 where the labor force was exceptionally tight and we saw the inflation shoot up and the wage inflation shot up to about 6% and total inflation hit 9%. We're trying to get that down still and we're not there yet, and the policies being put in place over the next few weeks are going to reverse that trend, which is why we never had a soft landing. We were almost there, we're not there, and we're not going there.
Well, uncertainty equals volatility, does it not? And if there's, look at the uncertainty. Look at consumer confidence right now. Look at all of the layoffs and what that's going to do to the labor pool.
What is consumer confidence right now? Do you happen to know?
Well, it depends on
whichever one you want. Yeah.
Well, I can tell you that I know that it dropped about 6 points in the last in the last month, and it was one of the largest drops over the last 3-4 years, something like that.
Okay.
So, when you start looking at this, look at Walmart. Walmart, one of the biggest and best mass merchandisers out there, 75% of their gains in fourth quarter came from high income earners that are trading down. Inflation, they can't afford. People are volatilely concerned about what's going on out there. Everyone's trading down. Everyone's starting to be concerned. You can't have a soft landing if you have uncertainty and volatility.
So let me respond to that. So I think, if tariffs are inflationary, it's only in the short term. So, according to the reshoring organization, they said that 32% of U.S. manufacturers is actually cheaper to manufacture in America right now, if you count shipping, supply chain risks, and all these other risks that come with it. And they calculated with 15% tariffs, 45% of U.S. manufacturing of companies, it's cheaper to manufacture in America. So yes, maybe lumber goes up, but it's for a minute until smart business people say, you know what? It's actually cheaper to log in Portland or the Pacific Northwest or wherever we get logs from, And
you sound like an expert on that.
Bob, do we know if we have the capacity for that supply to be moved onshore?
It does take time.
It takes time. It takes time. But can I just dispute this 25% number? John's trying to scare you guys with the 25% number. He's trying to imply that 25% of tariffs is 25% of the U.S. economy. Actually, it's nowhere near that number, right?
What?
When I use Venmo to pay somebody, that's not a tariff. When I pay my electricity bill and that electricity is created in the U.S. from oil that we burn in the United States or solar panels that we use here, there's no tariffs. Tariffs are 25% of a small portion of the U.S. economy. And it's very, very important to understand that. So don't buy into this kind of thought process that 25% is going to go up. Nothing like that. Even in the construction market, which is probably the most hurt from tariffs compared to any market in the U.S., the numbers that came in was a 6, perhaps 8% increase in construction. And that is the worst hit market. Inflation is a factor of millions of things. Tariffs are one of them.
So 6 to 8%, the cost of housing construction goes up 6 to 8%. Is that above or below 2%? I'm just checking.
It's only a tiny portion of the economy.
Only just a little bit.
It's only a piece.
Okay, yeah. And
Let me show you this thing. This is called a pie graph.
Wait.
This
The
thing called
housing market
slices.
is only a piece? This unaffordability in the housing market is only a small piece? Is that what you're saying?
What you're trying to say is that all of a sudden tomorrow, 100% of the people in America need new construction. Have you forgotten that we have 155 million built homes in the United States? They're already built. They're already here.
There's no inventory for, there's no
Wait,
home inventory
and the
right
price on those is going up by how much?
Yeah.
About maybe 6.1%.
Actually, there are
in
no
case that you need
forecasts
some
for
help.
this year for home prices to be above 4%. Please
Home
check.
prices are going up
2 to 4%.
6.1% as of last month.
No one has forecasted that for 2025.
Okay, gentlemen, I think we made our point. We've been talking about consumer prices.
Oh, wait. One more thing. Neil, I really appreciate your clarifying for me what I'm trying to say. That really helps.
So we've been talking about consumer pricing, and I appreciate the back and forth on affordability. Let's talk about the investment buckets of capital. I'm going to start with you guys. I'd like to ask the question, right now we've got a price-to-earnings ratio of, 23 times? You guys will correct me on this. And commodities like gold have doubled in value over the last 5 years. I hope I'm not making that up. That's what I keep reading. So talk to me about that. We have not seen any type of correction in the equities markets, in the commodities markets. And so is that an indication that we have yet to have the correction for a soft landing to matter?
Well, I think I'll go first, Bob. It is fairly normal for the equities markets to be at 20, 25, and even 30x. Will adjustments happen? Yes. But the implication that adjustments will only happen through a recession doesn't support the data. The vast majority of the time, PE ratios in the United States correct through increase in net operating income of companies. Go back and look at the last 100 years. You'll see the vast majority of the time, the ratio comes down because companies make more money. And take a look at corporate balance sheets. Does this look like a recession? This looks so far from a recession.
If you read the history of the United States in 5 economic crashes, typically the correction occurs because of some type of fear in the marketplace.
Sure.
A lack
Where's the fear?
of investment confidence.
No,
Okay.
But where is that fear? At this point of time, the vast majority of the billionaires, the mega billionaires in the United States believe, and they believe it almost like a religion, that artificial intelligence takes us into a completely new era. All of the people with the money believe that, right? All of them have been interviewed 1,000 times on YouTube. How do you get confidence levels to come down when companies have very, very strong balance sheets? Companies are doing well, profit numbers are high. I think that the PE ratios adjust, and they adjust by simply having higher profits.
PE ratios are high because people expect growth. And I lived through the late 1990s. Everybody remember the internet boom, and it changed everything. And it wasn't just a bubble. We saw GDP growth during the late 90s average about 4.5%, incredibly strong for America. I believe the AI revolution is more powerful than the internet revolution. It's going to result
10x.
in more productivity, and that's why the market hasn't crashed. You're seeing
Before or after
massive
the
going up.
dot-com bust? With the internet stuff, before or after the dot-com bust? Again, when you have such a dramatic fall, it's easy. Just like you guys talking about COVID.
It's not
when
about
you have
the stock
such a
market,
dramatic
it's about
fall,
the economy.
you have nowhere to
and
build it up.
even when the dot-coms blew up, it didn't blow up the economy. We had economic growth. The truth is AI is real.
AI
it is
is
massively
real.
increasing productivity.
AI is real, but you kind of need power and data centers and all the stuff which, by tech's own admission, is lagging behind, and they're desperately trying to catch it up. So what you're going to see happen is this AI mystique is going to come down just a little bit and level out, and people are going to realize, yes, AI will be a big game changer, but it's going to take a hell of a lot longer than people are letting on right now.
We didn't see that in the dot-com revolution.
We
saw
saw it
companies
when the dot-com
capitalizing
busted and fizzled.
and having incredible growth rates justifying
After 10 years.
elevated,
After 10
elevated PEs.
exactly.
Things are moving much faster now because we have the infrastructure that
Okay,
we didn't
5
have when the
years.
internet was created. Much faster.
Oxford Economics said 10 years. That's what they say.
So against team,
Do
would
you
the
think the
argument
Fed's
then
going to be unhappy if inflation's a little bit over 2%? The fundamental belief that the Fed is only happy with 2%.
Isn't it okay if inflation is over 2%? Now he's trying
That
to
is
move the
your
goalpost.
definition of a soft landing, and it doesn't meet
Powell
prior
moved the
definitions of
goalpost.
soft landing. If inflation is 2.1%, we don't have an unhappy Fed. The Fed wants full employment. Its
Okay, did we
mandate
get to
is
2.1?
dual.
I'll give you 2.1.
It has two mandates.
Are we at 2.1?
Was that?
You said 2.1.
Whatever that number.
Wait, when
If
did we
it's
get to 2.1?
Let's just say if it's over 2%, is that an unhappy Fed? Can a real estate cycle take place, a new one? At 2.2%? Yes. 2.5%? Yes. Maybe not at 5, maybe not at 4. But a real estate cycle is part of the question that Ben's asking. So our friends are basically only taking the first half of the argument, not the second half that Ben has clearly mentioned, that
take
we
the second
actually
half.
have to start a new real estate cycle.
Okay,
That cycle can take place at over 2%.
I want to give the against team an opportunity to respond. And I'd also like to incorporate, is there any merit to the lack of potential correction in the equities and the commodities market?
So we haven't had a correction yet. But what we have seen is uncertainty surge. What do you buy when you're uncertain? You buy hard assets like gold. Gold's way up. You buy real estate. Uncertainty, think about this. When was uncertainty highest? The highest point of uncertainty was during the pandemic. Number 2, the second highest level of uncertainty in the United States history wasn't the global financial crisis. It wasn't when the government shut down. It was yesterday. Yesterday, uncertainty hit a new peak in the United States. So what are you going to do? You're going to buy gold. The equities market is getting shaky. What happened yesterday? I think there was a big sell-off, actually. I think it dropped quite a bit. A couple percent, maybe?
Look at today.
I haven't looked today.
Yeah,
it's
don't.
kind of scary. But the 10-year Treasury is falling because money's moving out of the equities market and into bonds. They go to bonds because it's safer during periods of uncertainty. The risk factors are elevated, and that's why Wall Street is moving now.
And somehow that's not deflationary. So let's say the stock market falls another 2,000 points. Let's say it falls 3,000 points. For some reason, the stock market falling is inflationary? No. Every time the stock market falls, that's deflationary because of the wealth effect. People feel that they have less money in their banks. That actually tends to reduce inflation in the US whenever this happens. You're talking about the VIX, which is the fear factor. The VIX has spiked a dozen times in the last 2 years. How many recessions did we have in the last 2 years?
Wait. Are we talking about recessions?
The VIX,
Are we talking
VIX.
about economic growth? Wait. Are we talking about a soft landing and inflation?
They're not separate. You're trying to separate the soft landing. The Fed wants full employment and it wants lower interest rates. And it makes adjustments between those two. It's always done that since the Second World War. For you to think that the only thing the Fed cares about is a 2% inflation rate, well, you're basically removing half of the Fed's job. And the second half of the Fed's job is full employment. We're at 4.1%. Could you name any of the last 14 attempts that the Fed has made since World War II where 29 months after they started the cycle, unemployment was at 4.3%? Could you name it once in the last 80 years?
All right, I'm going to put a period on that. And for the sake of clarity for the audience, I think the argument here was not that it would be deflationary, inflationary, but perhaps the landing hasn't occurred yet since the recession hasn't come for the landing to occur. So without having to go back and forth on the semantics on that, I want to hit one more topic. And I only want to cover it in about 3 or 4 minutes. So succinctness is key here, folks. And then we're going to go to our closing arguments. I want to see where wealth inequality or income inequality play into this. So wealth has gone up, even for the lowest bracket of the bottom 50% in the last 5 years, I think by 45%, something like that. Income is up by 17%. That would be an indication that this team has some merit for. But at the same time, labor force participation is down, and by your own admission, 10% of the federal workforce is about to be laid off, and perhaps that's going to follow suit across other industries. So how does the potential for wealth and income inequality play into perhaps that there's two different stories being told here? When you smash them together, we get a bit of confusion, but on one side of the wealth structure or the one side of the income structure, it's just a different story for two different groups of people. Anybody have any thoughts? Want to kick us off?
John's like, what was the question again?
How does wealth inequality or income inequality, if you would even define it that way, play into this subject about whether or not a soft landing has been achieved? Has a soft landing been achieved for those who already have?
The Fed
or
does
for
not
everyone?
have any mandates regarding inequality in this country. As far as the Fed's concerned, if they can keep inflation at a reasonable level and keep unemployment down, they will happily take a country. Because the Fed says that is the job of Congress. It is Congress's job to reduce inequality in this country. The Fed does not ever take a position on inequality and never has.
Okay.
So let me toss something in here. And I think what you're getting at is who's feeling the inflation, right? So when you look at it, if you're really wealthy like Neil, you don't care that the eggs are $5 a dozen instead of $1.50. You're like, if it's $5 a dozen, as long as I can get them, I'm happy. Okay. Now, for somebody who's making $20,000, $30,000 a year, and they are paid a substantial portion of that in rent, and they're trying to make ends meet, that is a meaningful change. So they're definitely feeling the impact of inflation at the lowest income levels, and that's something the Fed has indicated they're sensitive to, but actually Neil's right. They say, look, this is an issue. We understand the people are hurting from this, but Congress has to do some things about this. But we're going to keep interest rates higher in order to get inflation down, in order to help people out. We want to have inflation. Here, wait, you guys tell me. What does the Fed want inflation at? Can I hear from you? 2%. 2%. Are we there yet?
A theoretical target that the Fed itself fails to achieve roughly 99% of the time. Go back and look at inflation for the last 80 years.
I appreciate it. We're not going to regress back to the same conversation. I'm going to ask one more question, then we're going to move to opening arguments, and Greg, I'm going to tee up for you, okay? Oil and lumber was invoked, and we haven't had a chance to talk about it, so I want to hear the facts, figures, stories, or throwing the poo-poo over the fence, whatever it is, about oil and lumber that was invoked, and then we're going to move to closing arguments. Bob, floor is yours.
Well, we are seeing, the economy of the U.S. is very, very strong. We're seeing super high growth, not super high, but reasonably high growth in spite of the Fed's aggressive raising efforts. But the rest of the world is comatose, their economy, which affects oil demand. So you're seeing oil prices continue to drift lower. It was 2 years ago, it was over $100 a barrel. Today it's hitting $70.
68, 69.
And so we're seeing Europe is comatose. China is dead, and the only demand is coming from the third world and from America. So we're seeing oil is going to continue to drop. And lumber, I think we've seen the huge volatility of lumber prices. It's very much based on supply and demand, and I think we'll see that come down dramatically, which we have been seeing. So I don't think those things are an issue.
So there's an argument here about the international global trade, and I'd love for you guys to incorporate that into your closing arguments if we can. So give these gentlemen a round of applause. That finishes up round 2. Are we having fun? All right. So now we're going to move on to phase 3 of this intellectual debate. And if you have joined us halfway through, we are arguing the motion that the Fed has achieved a soft landing and a new real estate cycle has begun. We're not going to go to the poll yet, folks in the back. We have got one more phase. We're going to do closing arguments. And so debating for the motion that the Fed has achieved a soft landing and real estate cycle has begun, we've got Neil Bawa and Bob Fraser. And against, we have Greg Katz and John Chang. So we are now going to move to our closing arguments. 2 minutes on the clock for each person. We're going to go in reverse order, inside out. And we're going to start with you, Mr. Katz.
So, look, they never defined when we had a soft landing, because we didn't. And again, I go back to the statement that John made. If we had a soft landing and it was done, if I'm Powell, I'm like, yo, soft landing here, look what I did. Hadn't happened. Never said it. Never hinted that he was going to say it. He's been saying, I'm concerned, and he's been saying that for months. If you go on what the definition of soft landing is, which is what they should be arguing, you still get to inflation is still high, and it's being felt. And it's being felt across all economics, all wealth, unwealthy, etc. It's being felt with layoffs in the job markets. It's being felt with high prices. It's being felt with housing that's unaffordable and no one can get into the system. It's being felt with tariffs and things like that are making real estate investment difficult, real estate construction hard to pencil. I don't see the argument here. It's pretty clear to me, at least, when you look. Uncertainty equals volatility. Volatility means not only the economic uncertainty, but the fact is that we're in flux. We've never achieved what the goal is to achieve. It's as simple as that.
All right. Giving 30 seconds back to the clock. I appreciate you. Okay, Bob, closing arguments.
All right, so they're saying there's no hard landing. Everybody knows we've had a soft landing here. Everyone can tell that. And so they're just saying it hasn't yet happened. They're just pushing it out. But let's be honest, if the economy is crashing, you wouldn't be sitting here in a packed conference talking about investment opportunities. You'd be sitting at home, stress refreshing your 401k balance. But you're not. Because deep down, you know the truth, that we landed safely and the next cycle's begun. So everybody, all these naysayers are looking for signs of doom, but they're missing the forest through the trees. We're entering a period of technological and economic expansion unlike anything else. AI is the accelerator, and when you combine AI's power with a fundamentally strong economy, which we've seen, what do you get? Growth, opportunity, and the next real estate boom. We've seen the economy power through unprecedented headwinds of rising rates and a global slowdown, and still powering up on the back of record consumer spending, record consumer cash, record consumer wealth effect, and record real income. My advice, don't get caught up in the short-term noise. Play the long game, because the investors who recognize this moment for what it is, an inflection point, will be the ones who win in the next decade.
All right. Another 40 seconds back. Thank you both. All right. John Chang, 2 minutes on the clock.
Bob, I love you. Don't miss the forest for the trees. Last time we did tariffs on lumber, the price of lumber tripled. So now, actually, Bob's right. They're talking about how do we cut more trees down in the United States. I was reading the article. They said, we're going to cut down more trees in the U.S., and it's going to help reduce wildfires because there won't be any trees left. So that's one. Neil said we haven't had 2% inflation in history. We never get there. From 1998 to 2020, the core CPI inflation rate averaged 2% on the dot for 22 years. Now it is way up. We're trying to bring it down. We haven't gotten there yet. Don't let Neil confuse the discussion. They talked about the economy doing good. Yeah, it has been doing good. That's not the point. The point is, did we get a soft landing? Did the inflation rate reach the target? Did the Fed say, yep, we're there, and reduce rates back down to something more reasonable? I'm not even talking getting it back down 525 points that they raised it. We've got 100 of that back, but they stopped. And they stopped because they're worried about inflation. We need to get that inflation lick down to 2%, get that Fed funds overnight rate down to something more reasonable in the 2 to 3% range instead of 4.25%, which is where it is today. The current estimate from FedWatch is that we will see 1, maybe 2 reductions by the end of the year. I'm personally thinking 1 may be even a bit of a stretch. So right now, my time's up. I'll hand it back.
All right. Thanks, John. All right. And to finish us off strong and entertainingly,
John's
Bawa, 2 minutes on
confused
the
about
clock.
averages. Already in the last 2 years, we've had lots of months where inflation was under 2%. I'm talking about averages, and you can't look at any 1 month and cherry pick. You've got average, and that's what I was talking about. Let's wrap this up with a reality check. We were told interest rates would trigger some kind of economic catastrophe. We've gotten one of the smoothest landings in history, so smooth that they're struggling, right? This doom and gloom crowd, they were warning of mass unemployment. Last year, they were telling us unemployment's going to be at 5 or 6%. We're at record lows, so the Fed has time. They're doing what they're doing because they're super comfortable. Earnings are climbing. Courthouse steps are empty. And while these folks talk about short-term wobbles, we see the bigger picture, and that is that the new real estate cycle is here. And we've debunked all of their hysteria. First, Biden was going to ruin the economy. Now Trump is. At this point, these guys, I think, have a prepare for doom on a keyboard shortcut. Just keep mashing it. Because no president is going to purposely tank the economy, guys. If Trump lays off 300,000 people, how does that increase inflation? Are unemployment out there bidding on luxury homes? Unless they're hiding Swiss bank accounts, I don't see how that math works. And let's not forget the elephant in the room, the AI in the room. We've seen a tech revolution. AI is creating massive jobs, raising productivity, injecting energy into the economy. And that's helping the Fed. right? These guys are next going to tell us that the internet was a fad too. AI is not a fad, it's real. So if you want to bet against this economy, be my guest, but history is going to remember this as a start of a new real estate cycle. And if you're smart, you won't just watch it, you'll profit from it, or you can do what the recessionistas do. Crawl back into your bunker, ration your canned tuna, and wait for a crash that never comes. Thank you.
And that concludes phase 3 of the 9th year of the best ever intellectual debate. Thank you so much for being here. The Fed achieved a soft landing and a new real estate cycle has begun. You, the audience, will determine who wins. So the for team, Mr. Neil Bawa, Mr. Bob Fraser. The against team, Mr. John Chang, Mr. Greg Katz. We are going to have the poll open up. Hit me with that magic pen now. All right, there is your scan to join. Once again, the winners are not going to be determined by raw percentage points, but the amount of influence that has occurred in your minds. Have they persuaded you? If so, they will be deemed the winners, and their reward will be to belittle the other folks on LinkedIn for the next 12 months, and that'll be fun to watch for the rest of us. All right, while you are doing that, while we're taking the next minute to vote, a couple of announcements. Right after this, 5:15, we've got the speed networking for LPs and GPs. You did need to sign up in advance, and that is taking place in the meeting spot right behind us. And then tonight, we've got the party at 8 p.m., Regency Ballroom on the 4th floor. It's Regency A. Thank you to Trevor McGregor. Drinks are on him. He's the man. He's been throwing parties here for 8 years running. So if you want to have some fun tonight, get a little bit loosey-goosey, we're going to be up on the 4th floor. Come hang out. We're starting tomorrow, half an hour later, just so you can get a little bit loosey-goosey. So we're starting back here at 9 o'clock. I hope you've had an awesome day of content. We're going to keep it rolling tomorrow. All right, 10 more seconds. Do we believe that the Fed achieved a soft landing and a new real estate cycle has begun? Are you with the let's get rich in 26 team? Or do you believe the Fed has either not achieved a soft landing or it's been a little bit rough and we're still in the same real estate cycle as 2011, 2017, 2021? Will it never end? Are we in the wait to fix it in 26 camp? All right, we're going to close the polls and we are going to now see who has won the 9th best ever intellectual debate. 55%. 55% to the 14. To the against team. To the against team. 55% to the against team. How about that? A 39% swing. A 39% swing. A 19% drop for the for team. And the uncertainty camp has gone from 29% to 9%, so quite a few minds have been influenced today. Congratulations to John and to Greg, and an extra special congratulations to Greg. These other 3 gentlemen have done this debate multiple times before, and it was Greg's first time. I'm grateful for you being here, and thank you to Esri for us bringing here. If you haven't checked out Esri, the data is awesome. I'm a consumer, love that in market for boat and RV spending index, so thank you for that. All right, and that is it for today. I hope you guys all had a great time. I'll see you tomorrow morning, or I'll see you tonight. Cheers.
Huge swing, huh?
That's a huge swing.
All right.
Yeah, tons of fun. Tons of fun.
I knew it.
Hey guys, while some folks are still in the room, let's do something interesting. Neil, what did you actually think? Like, what's your real opinion?
John's data was powerful. My job was to misdirect.
What do you think, Bob? What was your real opinion?
Yeah, I'm definitely for.
You're definitely for. Okay, all right. So we got a grifter and a believer. And what was your opinion, John?
It's a simple yes or no question, and we didn't meet the milestone. It didn't check the box.
All right, so you actually move it. And Sam?
I mean, I'm undecided.
All right, so thank you to these guys for being entertaining and playing the sport. All right, see you guys tonight.
Thank you.
That was fun.